Hey guys, welcome back. I'm Grady Cool, CEO of Cool Wealth Management. The market has been on a wild ride since Trump took office. Whatever your opinions may be of the guy, it's got me thinking, when is it time to play it safe with your investments? I'm going to share 4 tips I use with clients every day. I'll give you an example for each and how exactly you can use this to make better decisions for your own investments. I've found that framing decision-making as questions before choosing actions tends to lead to the best outcomes. The first question we can think about is, what are your short-term goals? I was recently talking with a client who, for confidentiality purposes, I'll call Sam. That's my brother's name, so makes it more comfortable. But this specific client was
20 years older than Sam.
Sam was worried about the news surrounding tariffs. For those of you unaware, tariffs are taxes placed on trades from other countries into the United States, and it can go both ways. The United States has recently decided to use tariffs on countries we have close ties with, including Canada. Sam was concerned that more tariffs, less trade equals worse economy, and worse economy leads to worse stock market. We don't know for sure until it actually happens, but generally speaking, that's a fair feeling. I can understand why someone would be concerned about that. I won't go on any sort of political rant here. Every plan has its pros and cons, but the more important question was, how does this specifically affect Sam? Sam wants to save money for retirement and help his kid save for college who's only 15 years old. Since Sam has almost 20 years until retirement, we're good there with the long-term planning because the market has plenty of time to recover. On the other hand, saving for college for his kid is much more of a short-term goal when it's only 3 years away. We don't have nearly enough time for the market to recover with 100% certainty over that time period. Thankfully,
as I reminded Sam,
we've been planning for this over the long term, so we had plenty of money set aside in cash equivalents to make sure we didn't need to worry about any sort of market fluctuations. If you have short-term goals that don't require much cash, there isn't much to worry about since the stock market over the past 100 years has always recovered within a 3-year period. However, if you have short-term goals that actually do require some cash, then having some money set aside in something safer like cash equivalents or bonds can do you a whole lot of good. Which leads to my next question. How will a change to your investments change the probability of success at your long-term goals? As we talked about before, the stock market, which is the main driver of growth in most people's portfolios, usually recovers within just a few years. If we move part of our portfolio away from something high growth but higher risk like the stock market towards something a little bit lower risk and lower return like cash or bonds, wouldn't that lower our overall returns? Yes, but there's more. We can use math with a few assumptions based on the last 100 years how changes to our portfolio will affect our probability of hitting our long-term goals in the long run. Take a look at our example with Sam from before. He has 70% of his portfolio in the stock market. With that much in the stock market, Sam's probability of being able to comfortably retire is over 99%. But here's the cool part. Sam makes so much stinking money that if he moves his stock percentages from 70% to 50%, his probability of being able to comfortably retire moves down only 97%. Now, why in the world does our probability of success lower when we go into less risky options? One word.
Inflation.
With his investments earning less, then he has less purchasing power. If inflation historically is only around 2%, this isn't much of an issue. But if things continue like they have the past few years and inflation averages somewhere closer to 4%, this could be a real concern over time. Not to mention, even if Sam hits the goal of comfortable living in retirement, which is some benchmark we've hit, then it doesn't mean that more money in retirement wouldn't be great. Don't get me wrong, not everybody needs $20 million to live a comfortable life. But it's much easier to be able to live off of 90 grand instead of 70 grand in retirement, especially when what those numbers mean will be significantly different by then. Not every situation is like this, though. The next question I would consider is, are there any suitable alternatives to what you're already currently doing? There are some situations where a safer investment can get you just as good a result as a riskier one. The key is how you measure the results. If you're going for absolute highest return, just how do we get the biggest number in my bank account, then yes, the higher, riskier option is going to be the one that gets you the higher result. But if you're looking at money as a tool to get what you want out of life, then there are plenty of situations where something with lower risk getting you the result that you actually want can be a perfectly good, suitable alternative and get you there with a higher percent probability. There are some situations where a safer option might get you just as good a result. The key is how you look at results. If you're looking for the absolute highest return possible, then the riskier option is, yes, going to get you a higher number in your bank account, generally speaking. But if you look at results in terms of how am I getting what I want out of life, meaning there's a certain outcome I want, and there's a certain probability that these assets I'm putting my money into is going to get me that thing that I want. Sometimes there is a safer alternative that will get you there with more certainty. That was a mouthful, but the reason I say it that way is because in finance, we can't say the word guarantee. That's the number one no word. Maybe it'll make more sense if we look at an actual example. Take, for example, a client I have. Again, confidentiality purposes, we'll call him Jack.
Yes, again, personal friend, but this time 30 years older than Jack.
Jack's a wealthy guy with a well-diversified portfolio. He has his money in a lot of different things. Part of Jack's portfolio is in Airbnb, meaning short-term real estate rentals. I recently saw in the news for the laws in his area that the government next year is considering making the laws around Airbnb tighter than they have been previously. Jack's been getting around a 15% return every year, but this would lower his returns potentially to 7%. Now, suitable alternative. We considered long-term real estate rentals with those exact same things that could get him a 10% return, and this is just because of where the law differences are, meaning he could have more certainty and less potential lawsuits, meaning when you rent out to one person instead of 50 a year, can make a big difference, meaning this is a more suitable alternative that might not get as high a return, but it still gets him his goal of being able to live comfortably throughout retirement. I realize this is a super specific example, but there are plenty of situations where a safer investment can get you just as good a result in terms of real life results instead of just the highest possible number. That being said, this is where having lots of financial knowledge of all of the alternatives available can be a massive help. The last tip I want to cover is definitely more advanced, but it's fantastic for scary short-term situations that will generally deal with themselves within a few months to a couple years. My last question is, could we use a short-term substitute instead of making changes to our long-term investments? That's a mouthful, but sometimes there just aren't better words. The most common example of this are derivatives. Derivatives is fancy lingo for taking bets on different types of investments. There are more options than you could possibly imagine. You see what I did there? Options, as in one of the most popular types of derivatives, eh? That was painful. While I did say it was betting, that was just to give you a general understanding. The more practical use for them is hedging. Hedging meaning covering risks. This is much easier to understand with an example. Jack owns 1,000 shares of NVIDIA from working there from the past 7 years. Jack believes that NVIDIA is a very good long-term hold, but is scared that they could do poorly in the short term if their earnings aren't too hot over the next quarter or two. Jack could hold out for the long term, but he wants the flexibility to be able to sell some of his shares in the case that he wants to start a new business within the next year. What he could consider is something called a put contract. What a put contract says is if we have a strike price of $115, which is relatively where NVIDIA was while filming this video, then if the price goes below $115, then he can still sell it for the $115 price. However, these contracts cost $10 a piece. So the price would have to go below $105 for Jack to have made any money in the process. But this does protect him from the downside of NVIDIA dropping like crazy over a short period if they do really poorly for a quarter or two. Derivatives can be used for all sorts of creative solutions, but they can be misunderstood quite easily, so definitely be careful and understand what you're doing before going buying any of them. To bring things back to our original question, when is it time to play it safe with your investments? Honestly, it really depends on what your short-term and long-term goals are. There are plenty of ways to make them happen. You just need to choose the options that work best for you.